Hello, welcome to the Webcast. I'm Angie, an IASB technical staff member. This is the second of a three-part series of webcasts to discuss some of the proposals related to the classification of financial instruments as financial liabilities or equity from the perspective of the issuer. When considering the scope of the FICE project, the IASB chose to clarify some of the underlying principles in IAS 32, the accounting standard dealing with the presentation of financial instruments, rather than making fundamental changes to address known practice issues. Where it is not possible to clarify underlying principles, the IASB developed new principles and accompanying application guidance. One of the practice issues is the interaction between contractual terms and legal or regulatory requirements. The IAS 32 classification is based solely on contractual terms and classifying a financial instrument in accordance with the substance of the contractual arrangement. Practice questions have arisen about whether a legal requirement that is reproduced or referred to in the contract should be included or excluded from the classification, and also whether a legal requirement that is outside the contract should affect the classification. The IASB's objective is to provide principles that would enable companies to determine whether relevant laws or regulations are considered in the classification. Having such principles would reduce diversity in practice and improve comparability by ensuring consistent classification for economically similar financial instruments. The IASB is proposing that a company would classify financial instruments by considering only contractual rights and obligations that are enforceable by laws or regulations. The contractual rights and obligations would also have to be in addition to those created by relevant laws or regulations. The emphasis on enforceability is consistent with the description of contract and contractual in IAS 32, and merely acknowledges that the contractual terms cannot go against the law or regulation. Considering only additional contractual rights and obligations means a company does not consider any right or obligation created by relevant laws or regulations that would apply regardless of whether the right or obligation is included in the contractual arrangement. This slide illustrates how this principle would be applied. For example, let's consider a bail-in instrument, which is common in the banking industry. The contract explicitly describes two features. Firstly, it specifies a particular loss absorption feature, such as conversion into a fixed number of ordinary shares if the issuer breaches a specified capital ratio. Secondly, it explains that the regulator can require a broad range of actions through general bail-in powers that include the conversion of the instrument into an unspecified number of owned shares or shares of another company. These general bail-in powers apply to all issues of similar bailing instruments in that jurisdiction and are not negotiable between parties to the contract. The specific loss absorption feature would be considered in the classification because the contractual terms are in addition to the regulatory requirements and specify the conversion features. In this example, in the absence of any other feature that precludes equity classification, the bail-in instrument would thus be classified as equity. The general regulatory powers would not be considered in the classification because they would apply regardless of whether they are reproduced in the contract. If they were considered, then all bail-in instruments would be classified as financial liabilities or include financial liability components because of the potential settlement in a variable number of shares, and this would result in significant changes in classification. In another example, if the legal requirements prohibit redemption of a financial instrument, the legal prohibition would be considered in the classification. The contractual obligation would not be considered because the law prevents the enforceability of the contractual terms. This is consistent with the requirements in IFRS 2, the accounting standard for members' shares in cooperative entities. In our final example, if the law mandates 10% of profits to be distributed as dividends, this would not be considered in the classification of the ordinary shares because the obligation arises from the law and would apply regardless of whether it is included in the contract. If instead the contract requires at least 15% of profits to be distributed as dividends, even though the law requires 10%, the entire contractual obligation to pay dividends would be classified as a financial liability component. Thanks for listening to this webcast. Please submit your comment letters on our website before the 29th of March 2024. We look forward to hearing your views.